All right, now with equity markets at all-time highs, it becomes all the more important to talk about behavioral biases. How do these creep into your decision making and what do you need to bear in mind? My next guest is Kiran Telang, who is a certified financial planner and an author. Thank you so much, Kiran, for joining in. Now, I want to ask, before we get into the biases that you've identified, when I reached out to you, you identified a few biases that we will talk about over the course of this conversation. How important is behavioral biases when you're talking about investing, and what do you need to bear in mind?
Thank you for having me over on this show. I think behavioral biases are a very important part of any decision making. I mean, not only related to investments, but even otherwise in life. What happens, especially when you talk about money, is that it has a lot of emotions attached to it. So, whenever there is a money related decision being made, invariably these biases creep in. So, a lot of these decisions that we make regarding money are based on the things that are in our subconscious, the beliefs that we've built over the years, right through our childhood. Those creep in unknowingly, and we behave in a certain manner and don't realize that we are taking certain decisions because of these biases, which have been so deeply ingrained in us. And it becomes important to be aware of these biases that okay, this might impact my decision in a certain manner, and we should take due precautions to ensure that we remain logical when we are taking these decisions. It's easier said than done, but at least a starting point could be being aware of these biases and their existence.
Because in a conversation recently I was having, I found out that I myself have a few biases without actually knowing them. So let's start talking about them. You've listed them out for me, and I'm going to start with the first one: herd mentality. It's something that I think is common. You mentioned this is something that you would see even outside of financial planning or investing. Let's talk about how it could affect investing, though.
See, herd mentality, or you may also call it social proof. So, this is something which happens when you see what people around you are doing and you tend to get influenced by it. So, the idea is, I mean, if you look at history, mankind was always, when in the hunter gatherer years, as human beings were developing, that was the time when being in a herd and behaving as per the herd, was useful. So if there's a wild animal attacking and you see somebody running, so you will automatically flee the place. You will not stand and analyze whether it could be a wild animal or it could be something that you could hunt. So that was the instinct which was inbuilt over so many centuries. But things have changed now, but still that bias is so deeply ingrained with us that we tend to look at what other people around us are doing and behave accordingly. So this creeps in, especially now if you look at the way markets are going up right now. So a lot of people are thinking that equity is the place to be, and they might tend to forget that it is still risky. So your next door neighbor or your friend or your colleague would have made money in equity markets over the years, but their circumstances could be different. They would have entered the market over the years, or they would have been investing for a very long time after understanding what they're doing. Just because they are doing that, it might not be right for you. So looking at what your environment is behaving, how your people in your environment are behaving, you start behaving in a certain manner. So that is what is herd mentality, and it might be harmful at times. A lot of times it is harmful. So you need to be aware of why you are behaving in a certain manner.
Where asset allocation strategies come into play. That's where understanding your own requirements as far as financial goals is so important. Let's talk about the next one. Hot hand fallacy is something that you've listed out. What is this, and how do you watch out for this?
Yeah, so hot hand fallacy is something like, for example, if you're playing a sport and you're doing very well. So, especially there's a basketball example which is often quoted in this context. So, if you're making the hoops every time, you think that the same streak will continue. Or if you're playing a game of dice, if you're getting a good score on the dice, you think the same thing will continue. But it is pure luck, it might just change any moment of time. So, likewise, in investing, what happens is, now, if we take an example of the current scenario, what has happened in the stock market since 2020, the market was very down. I mean, it has crashed in March 2020, and then it went up, very highly. So people probably who have entered at that point in time and it was sheer luck that they made money, they might tend to believe that things will continue in the same manner, but it is unlikely because there is always a cycle which keeps on coming in. So it is not necessary that things continue in the same manner as they have been doing over the recent past. So you have to be aware that don't overestimate the good luck which is doing the rounds at the current point.
Absolutely. In fact, a couple of things come to mind. Specifically, a conversation that was happening earlier this morning, Kiran, where we talk about the fact that the equity markets haven't corrected, or at least the benchmarks have not corrected by more than 5% over the last 6 months. So that is something definitely to bear in mind. The next one is hindsight bias. And one of my favorite quotes comes to mind: the wisdom of retrospect is flawless. Does that have anything to do with this?
Oh, absolutely. That's what it says. The hindsight bias is that in retrospect everything looks perfect, and that was to be expected. But when you're in midst of things, you have to make decisions at that point in time. So right now we are in a flux. So what do you do right now with your investments? Do you stop your SIPs, or do you buy stocks, or do you get into alternate assets like cryptocurrencies? So at this moment, you will have to take decisions on whatever information is available. Now, if you look at this point in time, say 5 years down the line, you will see that certain decisions were right or wrong, and you will say that this is the way it should have happened. This is the way obviously it would have happened. Likewise, I mean, if you're looking at say what happened in 2008, 2009, during the crash, so it seems very obvious. This was the obvious way things were to happen. But when you're in the middle of it, you don't realize. So don't make your decisions based on the hindsight. Things are something, there is a lot of luck. There are too many moving elements in the entire investment basket. I mean, there are global impact, there is local impact, there is political impact, and there are so many moving parts. It's impossible for anybody to predict what is going to happen next. So just looking at hindsight and making your decisions that, okay, because last time it fell for a very short period of time and the market recovered, the similar thing could happen now. So buying at every dip might not be a correct option.
Another thing comes to mind, Kiran, in the context of what we've seen over the last several months, is that whenever you had the Nifty 50 hit a new record high, people said, oh, now is the time to sell. And in fact, we are at an all-time high even now. So let's hold on to the next one. There are a couple more to talk about. We'll slip into a short break. Kiran, do stay with us. On the other side, we have a couple more biases to tell you about. That'll hold you in good stead. Do stay tuned. Welcome back. You're watching The Money Show, and we are speaking about behavioral biases and how they creep into your financial planning decisions, in your investing decisions. I'm in conversation with Kiran Telang. Kiran, a couple more to talk about. The next one you've listed out is sunk cost fallacy. What's that about?
So, sunk cost fallacies that if you will continue with that thing despite knowing that it is no good for you or it is a lost cause. Let's take a simple example. If you're watching a movie which you don't really like and you would like to walk out, most likely you will not do so because you've already paid for the ticket. So you will continue watching a movie and wasting more time on it. So that is a simple example. This reflected in the money parlance is if you see, the stock portfolios of a lot of investors, they tend to sell out the ones which are actually making profit and which will, do well over a long period of time, but they still hold back those investments that are loss making and probably where the companies are not really going to, turn around or show any kind of profits at any point in time, which is foreseeable. So we see a lot of these kind of things where people, just because they put money into a thing, they will continue with even a loss making and a bad proposition. And it also, I mean, feeds into another thing called anchoring, because you're anchored to a particular cost. In terms of selling that particular stock that you're holding in your portfolio, you will hold on to it till that stock price is reached. So there are two biases at play here in tandem.
Absolutely. In fact, I think in these cases, especially if you're talking about stocks, Kiran, a stop loss is something that a lot of people advocate, where you draw a line somewhere and you say, okay, beyond this point, I will not hold. I will book losses if I have to. Let's talk about the last one that you've listed out, and perhaps one or two maybe that I also have in my mind. We can maybe discuss that. Confirmation bias is what you've talked about. What is this about?
We are seeing a lot of this bias. I mean, it plays out very often. So, if you have a certain belief, say for example, you are, if you took a look at the current things, especially related to cryptos. So, a lot of people are for and a lot of people are against. So, generally what happens is that are in line with your thought process. So, if you're either for it or against it, you will not look at the other side of the coin, and you will keep on forming your bias because you keep on looking at the same kind of information. So because you've not looked at the other side, your decision might not actually be correct, whether to go for that particular investment or to keep on building upon that particular view without trying to look at what could go wrong. So that is a confirmation bias.
Absolutely. And like you said, Kiran, at the start of the conversation, knowing about these biases is the first step to recognizing them, one, and then being aware of the fact that this is actually happening. I think the last one that you mentioned, confirmation bias, a lot of people have faced this in the equity markets as well, where they say, okay, you think that something is going to happen, say a mid-cap company is going to do incredibly well, and it doesn't necessarily turn out that way. Thank you so much for taking the time and for listing down all of those biases. I'm certainly going to be helped by it, I'm sure. On that note,
Thank you so much.
On that note, we're slipping into a short break, but we've got more on the other side, so do stay tuned.